is Brian Pearce, IATA Chief Economist. And you heard very briefly this morning some of the top line figures from Alexander, and then Brian gave a little bit of a presentation towards the end of the morning, but now we're going to go into more detail. And then after Brian's presentation, we'll have time for some of your questions. Brian.
Thank you, Perry. So I'll just run through a few slides. I think you've got the printouts and you've got the forecast packs, so you should have the numbers. I'll just tell you a bit more about the story behind the forecast. I guess the first one is about the increased connectivity that the industry is bringing. We think there's going to be an additional 1,000 cities connected this year. That's we've seen that more than double over the last 20 years. Lower and lower real cost. This is the real contribution the industry brings to both consumers and the wider economy. The value of trade the industry is carrying, although cargo is having a really tough time. We think the industry is still going to be carrying almost $7 trillion worth of trade. That's about a third of international trade. The tourists that are being carried are going to spend, we think, around about $900 billion. Again, these are the wider benefits that we see the industry bringing. Supporting jobs and also GDP in the wider economy. But clearly the airlines doing this are coming under some pressure. We're actually some way away from that peak period in 2015, 2016 when profit margins, profitability peaked. We've seen a slow squeeze. In fact, that squeeze on profits intensified middle of last year. What we know happened in the fourth and first quarter of this year is a bit of an easing of that pressure, but the pressure was still down in the first quarter, particularly on airlines in Europe. Not so much in North America, particularly in Europe. And I think what we've been seeing happening is, because the economic expansion has been so long, we're seeing generalised cost pressure. When a long economic expansion has created shortages, so the cost increases we're seeing in aviation is really reflecting what we're seeing in the wider economy. And you can see from the red line that airlines have been seeing their financial position squeezed by higher costs really for the last 18 months. And I think that's going to carry on this year unless we get a recession. And next door you heard me give that hostage to fortune by saying we don't think there will be one this year. But a new challenge has been that from the middle of last year, airlines found it very difficult to recover the costs. We've seen unit revenues. Unit revenues were keeping pace more or less with unit costs for much of the period up to the middle of 2018. Not quite, but more or less. A lot through higher load factors, and the rest really through ancillaries. But, as you can see, that ability diminished quite rapidly. And I think that's really what the thing that's caused the squeeze that we've seen on airline profitability most recently. Of course, the big question is recession. Are we going to get one? Cargo, often the canary in the mine, often the lead indicator of wider problems. Particularly in this region, cargo is down almost 10%, and it's a really important generator of revenue and profits. Asia is still the manufacturing part of the world. It's airlines in this region that have been suffering disproportionately from what we've seen happen in the cargo market. But the passenger business is still actually pretty good. And what we're seeing, I think, is shown here by what's happened in the wider economy. We've seen the trade disputes between the US and China and other trading partners really lead to a collapse in world trade. First quarter of this year, world trade was shrinking. 9 months ago, it was growing at a pretty strong pace, 4%. that is what's causing the problem that we're facing at the moment. Clearly, we're seeing the trade dispute being ramped up. We've got a threat of autos tariffs. It could get worse. We've seen what happened as a result of the tariffs imposed in the first half of last year. We're hoping it won't. But I think the broader point is that there's an offset to that weakness. As you can see, the global economy has not slowed proportionately to the weakness in trade. Actually, governments have been putting money back into the economy through fiscal policy. The US Fed stopped tightening. So there are some offsetting factors to the weakness caused by trade, which is why I think that, while it would be a surprise not to have a recession in the next few years, at the moment it still doesn't look like we're going to have one in 2019, and the passenger business is driven more by GDP. Clearly, though, this is bad for cargo. So this is what we expect this year. The average growth, freight, really at best zero growth. Could easily be weaker if the situation deteriorates. That's our best estimate given the current conditions. But actually the passenger business, although it's certainly slowed, reflecting the slowdown in GDP, it's only just below trend. I mean, that's so at the moment, whereas the cargo business is falling as steeply as it did pre-global financial crisis, that's not true for the passenger business. That's still holding up. It's a very diverse world for the passenger business, and this is what happened last year. We saw exceptional growth in India, although, as you probably know, that actually has turned negative now, but we think that those temporary difficulties caused by the exit of jet from the market. Good growth in China and Russia too, but in economies like Brazil, much weaker growth. So a diverse picture. Diverse picture again this year, we think. You can see from the Asia-Pacific numbers that we're expecting quite a sharp slowdown, reflecting what I've just mentioned, the fact that India market has suddenly weakened. We think that's a temporary move, but even so, Asia-Pacific is probably where the strongest growth is going to be. The biggest longer-term change has been with the Middle East, which is going through a big adjustments process now, with the business models changing with Etihad and even Emirates as well, with changes in the growth of capacity, which have been very different to the expansion we've seen in the past. By contrast, North America actually is looking pretty good and pretty strong growth there. I think perhaps one change in behaviour today to certainly 10 years ago is that airlines are sort of ahead of the game in that they have responded to the weakness of demand by cutting back planned capacity. So we know from the schedules that have been published that ASK growth is slowing quite steeply. So actually, this is not true for the cargo business, but this is true for the passenger business. So load factors are likely to stay high. That business is looking more robust than the cargo business, which is clearly facing a very difficult time. Unit costs, I think, will be one of the big challenges again this year, as you can see from this chart here. We don't think there's going to be much cost recovery from fares. Base fares have been falling. We think they'll probably be more or less flat this year. But airlines are sort of turning to getting cost recovery from ancillaries, and that's the main area. We don't think that probably won't keep pace with the rise of costs this year, which is why we've got a further squeeze on profitability because of the weakness of the market. But what we've seen here, I think, is this is the thing that is fundamental to driving airline profitability. This gap the industry has managed to achieve between load factors, it's a very capital-intensive industry, so load factors, utilisation are really key drivers of profitability. And this gap between what's a break-even for load factors, the wider that gap, the more profitable the industry is, the higher the return on capital. And clearly it's been narrowing over the last couple of years because of the rising costs that the industry has been facing. Actually, one thing that's mitigated that rise in break-even has been the emergence of ancillaries. That has helped the overall yield of airlines, and that's slowed the rise in break-even. That's one of the factors that kept this gap wide. But I guess the other thing is the load factors. Typically in the past, this industry would see very volatile load factors as new aircraft were delivered. It would collapse. We have, I think, seen a change in behaviour, and airlines, have responded to rising break-even with higher load factors. But it is clearly narrowing, so that's the thing that's causing the weakness in profitability this year. So, in terms of the metrics that are important to investors, return on capital, this is the picture. Whereas we expected stability in December, we now think there's going to be a decline because of the weaker growth environment, higher fuel prices. But it's still just above what investors would earn if they took their capital and invested it elsewhere, which is known as the cost of capital. So it's still an industry which is creating value for its investors for actually what is the 5th successive year. And you can see this rather remarkable transformation for investors that happened back in 2015. I think it is important that the industry continues with this, not just because airlines want to earn decent profits, but because they need to carry on attracting capital to invest in more fuel-efficient aircraft and technologies that are going to help solve environmental challenges we heard about earlier. So I think it is critical that this happens, and you can translate that chart into absolute dollars, billions of dollars of value created for investors. And you can see, the black bars show that the last few years have been good years for investors in airlines. They've seen up to $20 billion of value created through their investments in airlines, which is clearly a very big change from the typical history of the airline industry. And as I say, I think this is important because of the need to continue to attract capital to invest in fuel-efficient fleets. In terms of net profits, we're looking at 28 billion. We were looking at something like 13, I think, before. So down rather than up a little bit, and margins are being squeezed. But as you can see, that's still quite a bit better than where we were just a few years ago. 28 billion sounds an awful lot of money. Actually, in terms of profit per passenger, it's just over $6. And as you can see from, airlines need those ancillaries and those surcharges to get that $6, because the base fare and cargo is certainly not enough to cover costs. So, what is actually still a really good result for the airline industry, actually still looks rather thin and fragile given the sort of environment that we're in. Again, I think it's going to be quite a mixed performance by region. So airlines in North America and Europe are actually still doing pretty well. Europe's under pressure. North America, I think we're going to see stability. North American airlines are probably in the best position in this current environment. But as you can see, we've got airlines in regions, particularly the Middle East, Africa, Latin America, which are still lagging behind the improvements that we've seen in other regions. So that industry level picture of an industry which is still creating value for its investors is very much driven by a few regions. We're not yet at the point where the whole industry is financially healthy. And I think my final slide sort of makes that point by looking at a balance sheet metric. What's important for survivability in difficult times is a strong balance sheet, not too much debt. And actually North American and European airlines have done a really good job at lowering the debt. And this measures debt to earnings. It's EBITDA, or a horrible acronym, essentially it's earnings. North American and European airlines are almost down to investment grade levels, so that gives them some comfort in if they're facing a cash flow shock or higher interest rates. They've got strong balance sheets to see them through. But there's vulnerability elsewhere in the industry, so we do need to watch out in other parts of the industry. So these points summarise what I've said, but let's open the floor to questions.
Okay, we do have a couple microphones. Maybe begin right here in the third row. We get a mic down to the third row. Great.
Hi, it's Jamie Freed from Reuters. My question is about the 7% of the MAX grounding. How much does that affect the capacity figures of this year? And do you think that was perhaps a lesson in size for some carriers because it has allowed them to pull back capacity in the market, or do you think that's needed in them?
I don't think so. I mean, I think the MAX fleet is sort of 2 to 3% of the narrow body fleet. I think it's less than 2%, maybe even less than 1% of the total fleet. Yes, it's about 360 aircraft out of the total fleet of almost 30,000. So it's actually fairly minor. It's been more important for some airlines than others. So I don't really think it's been a driving factor here.
I saw a question right there.
Just a couple of questions for financial specific. What you said about you're looking at perhaps a sharp downturn, I guess, at the moment. First, I'm just wondering what you're seeing there apart from it. And secondly, on the financial health side, it seems like we've seen a lot of the last region reporting falling profits. So just curious what you see from the financial health aspect.
Yes, I think profits are clearly under pressure in the Asia Pacific region. Cargo can be up to 40% of revenue. Cargo is clearly really important. I think it's a fairly mixed picture though. There's no one market obviously in Asia. And we're seeing the situation in India with the jet exit, temporarily at least helping to improve profitability of the airlines there at the moment. But I think cargo is such an important feature that the weakness in trade and the risks around trade will mean that profitability is going to be weaker in this region.
Sorry, what about the sharp downturn in demand?
Sorry, the sharp downturn in
demand.
We can't hear you.
Sorry, yeah. You mentioned the sharp downturn, I think was that in demand for Asia Pacific?
Sharp downturn in demand, did you say, for Asia?
Not in the passenger business. We've seen some weakness in the Indian domestic market in the early part of this year. But I think overall we're still seeing pretty strong growth, and consumers are in pretty good shape in this part of the world. So I think we still expect to see reasonable growth in passenger business in Asia Pacific. I think it's cargo that's going to be really the thing that's really damaged.
Sorry, I should have asked earlier, please identify yourself when you ask your question, and we'll go here, I think, first.
This is Andrea Schultz of Pearce Travel Germany online. As far as premium business is concerned, since the development of premium economy, more and more business travelers, travel managers book their travelers on these new class offers. Have you seen in the general development a decline or cannibalization of business class versus premium economy, or was that the opposite, an additional impact in the development of higher yields for the airlines?
Well, I think that what we've seen really since the global financial crisis is that the corporate traveller businesses have become much more price sensitive, and so they've been so business travellers have been flying more and more in cheaper seats. But I think premium economy and those classes in between business and economy have been a fairly effective way of reducing the flow of higher yielding passengers back into the cheaper seats. So I think that has been a positive development, as well as offering choice for the leisure traveller as well.
I think, so Seth's hand, now we'll go to Steve Greedy over there. So Seth first, maybe?
Hi, Seth Miller from atn.aero. You mentioned that you think the dip in India's growth is going to be temporary related to Jet's exit from the market. I'm curious, back in December in Geneva, another executive suggested the growth in, an executive suggested growth in that region is terribly irrational and wasn't sure how it would be sustained financially. And we have seen that hit now at least once.
Yeah.
How are you getting to the conclusion that it's going to be a short blip as opposed to a more systemic issue there?
Oh, because people want to fly in India, and incomes are growing, middle income, middle class household numbers growing. I think the irrational was mainly referring to some of the capacity or some of the airline growth that there had been in the past. But I think the Indian consumer will want to travel more. The average flight frequency in India is sort of less than one trip every 2 or 3 years, compared to twice a year in the US. There's a long way to go. So I think the negative growth we saw in April for the Indian domestic market is a temporary thing. We'll see that market expanding more quickly in the coming months.
Okay, Steve?
Hi, Steve Greedy from Airline Ratings. Just a quick question, Ryan. The load factors are up, the demand is only slightly below trend, so why are fares not going up as well with the load factors?
Well, I think perhaps airlines are having to fill those seats by keeping those fares low. So what's hard to tell is what the underlying demand is. I think also there's a change in model. So I think airlines are increasingly pricing the base fare close to the marginal cost. They're recovering costs when they can through ancillaries, although obviously that varies quite a lot from region to region.
Down in front.
Hello, it's Luke from Hong Kong Economic Times. I have a question about the mass. When you're revising down your forecast, do you have an estimation on the cost of the mass grinding, or an assumption on how long will be the grinding? And you just mentioned that the mass only contribute 2 to 3% of the fleet of the industry, but we see the great amount of the mass in the order book. Do you think if the grinding is extended to the end of 2019, there may be a risk for you to further revising down your forecast of the industry revenue and also the profits?
I don't think that would cause us to revise down our forecast for profitability. I think what I should say though is the exact I mean, clearly it's a cost to the airline industry, but the exact effects are actually quite hard to unravel because airlines have been pulling other aircraft, they've been leasing aircraft, they've been rescheduling services, so a lot of those holes have been filled, probably more expensively than they would have been otherwise, but it's actually quite difficult to say. So at the moment it's not a driving factor.
We have a question here in the third row. Yeah, right there.
Hello, Big Les Echos. This morning, Violeta Bulk said that the environmental cost of air transport could be estimated at 33 billion euros. So, do you know how this? What is your estimation? What do you see at that figure?
I haven't seen that cost. I mean, I haven't seen that report. I think they've only just released it. So we'll need to take a look at that. I mean, I think the industry clearly acknowledges that there are costs, environmental costs to flying, but there's been a huge industry effort to deal with that through capping emissions in the Corsair scheme, as well as the aircraft that airlines are buying are typically 20 or 30% more fuel efficient than the ones they're replacing. I mean, the challenge the industry faces is not that it's not trying to reduce emissions, but more and more people want to fly it. It's the Corsair scheme is a way of addressing that growth and capping that growth. And then, as you heard from the Director General, the big thing that the industry is pushing are sustainable fuels to solve the longer term problem and cut emissions by half.
Can we go here in the third row right across, then we'll come to Marissa, and then we'll do Robert. And I can't remember what the name is.
Hi, Dina Gan from the National Newspaper in Abu Dhabi. Can you tell us what is in terms of the Middle East airlines projections there, can you tell us what is the base assumption for the order price that you use for this calculation? And also just a follow-up question, you talk about how performance is improving, but the business environment is worsening. Can you unpack that a little bit? Are you talking about oil price and currency volatility as well as the geopolitical tensions?
Sure. And obviously the growth environment has weakened particularly for trade. But actually our forecast is also based on higher oil and jet fuel prices than we thought back in December. Back in December we had an oil price assumption of 65. We now think 70 is more likely. More than that, we're actually seeing the spread between jet fuel and crude oil widen because of environmental measures in the shipping industry, which are causing them to buy more diesel, and that puts pressure. So we've actually got a widening of the crack spread. So that's been quite a significant rise in costs we didn't have in the forecast before. The improvement in performance I was talking about was that airlines are very busy restructuring, particularly in the Middle East.
I have two questions that are interrelated. The first one is, with the trade issues that you've highlighted, do you feel that premium seating, premium capacity is particularly vulnerable?
Yes. We do find that premium travel is linked to trade. Obviously, getting export orders is not the only purpose of business travel, but there seems to be quite a link there. So that's one of the reasons why yields have been under pressure recently as well.
That was actually my second question, which is, with regard to yields, do you believe that an over-reliance on ancillaries may end up kicking back on airlines?
I think airlines they'll respond to consumer, what consumers will want and will be willing willing to pay. I mean, I think the unbundling of airline services is probably still in its infancy in many parts of the world. I think probably particularly in Asia. So I think we're some way from an over-reliance.
I get to Robert here. One more after Robert.
Yeah, two questions actually. One is just a follow-up on the IMO 2020. So just checking, because 12 months ago you guys were worried about that but hadn't seen effects. So just want to confirm you are now seeing effects. And then the second question is basically about the trade situation. To what extent does your revision reflect the current state of play, as in, we since the last few days got Mexico, and obviously there's been talk about some of the EU stuff blowing up again. It's just been kind of a baton. So would you say this is a conservative estimate that you've given us, or would you say it's more downside pressure than upside?
So on the first question about the spread between jet fuel and oil, we're not seeing it yet. We're still not seeing the IMO environmental regulations, but I think that might be because we've seen quite a sharp rise in crude prices, which typically compresses the spread initially. But the spread is probably around 20%. We expect it to be 25%. So we're building in that risk. Our world trade and cargo forecasts are really based around the current situation. It could get worse. We hope it won't.
If we can do the gentleman there, he had his hand up. I think that's probably going to have to be our last question.
Mihir Mishra from the Economist. Thanks for having me. We mentioned that your post-jets exit out of the Indian market. The other Indian carriers have seen an increase in their yields. Can you give us some estimate as to how much increase in yields have they seen? One. And two, where the earlier yields unsustained?
I can't actually. I don't have those figures with me. I mean, there certainly has been some improvements in yields as a result, but I think that is probably a temporary factor because we're seeing parts of jet stream being introduced into other carriers. I think it will come back, and we'll see a resumption of that.
Earlier yields, pre-jet yields of Indian carriers, was it unsustained?
I think it's always very hard to say whether particular levels of prices or fares are unsustainable. I mean, if you've got the right business model, you can make it work. And I think in any market, particularly emerging markets, you see a lot of experimentation and innovation from players, which is part of the natural market process. Sometimes they don't work.
I'm afraid that has to be the last word. So thanks very much, Brian, for joining us today.
Thanks for listening.
I appreciate everyone. If you haven't grab some lunch, go ahead and grab some lunch. Grab some more lunch.